that going. Then we click the button. And we're live. Hello, friends. Mic check 1 2. Hello, everybody. Good to see ya. Chat is bumping. Smash the likes. We're going to get this underway. Hello, everybody. NVIDIA is crazy. That's true. Excellent. I'm excited about today. I'm excited every day. But today's going to be today should be good. You know, we got things to talk about. What's up, everybody? Let's do this. Hello. Welcome, friends, to Alpha Beta Soup. It's your boy TXMC. Hit the likes. Say hello to your friends in the chat. What's up, everybody? Thanks for being here. Lots of green names. It's excellent. Welcome. Before we even got started today, Stephen Edinburgh gifted 5 memberships. Thank you, Stephen. Everybody. Man, hope y'all had a good week. It is February 22nd, 2024, 11 a.m. on a beautiful Thursday morning, almost afternoon. Yes, little spicy on the timeline today. I decided to post very clearly that I think we're near the top for the markets. Because someone complained that I'm not very clear about my views and that I post a lot of cryptic things and, you know, whatever. So I just decided to be real clear. I think we're near the top. Put my balls on the line. If I'm right, I'm right. If I'm wrong, I'm wrong. But I've been saying it, and now I'm going to say it clearly. Here it is. I think we're near the highs. Don't know if the Pico wick has been printed. I'm not trying to guess that. But I think we're within spitting distance of the highs for Bitcoin, probably the highs for equities. I would think those two would be related to each other. I think altcoins are going to go with those things when they go, but I think we're at the point now where Bitcoin's done most of the work. It's gone about as high as it can go. And I think the next phase here is a cooling off of BTC, the last gasp of the altcoins. Maybe a little bit higher on certain points in equities. You know, the Dow Jones hasn't quite finished its whole trek to its full fib extension the way the Nasdaq did. So probably, some volatility left here up at the top. It's a secular turn that we're talking about. And a secular turn doesn't develop in a day or a week. It's something that takes place over time, and you look back and go, wow, that really was a turning point. But what we've seen in the past, when BTC starts to slow down on one of its moves, it's usually the time when alts start to move. Here it is at the 702 retracement. It's been here for over a week, and today it's down and alts are ripping, mooning, ascending. Look, we got things up 20%, a bunch of things up 10, 15%. Most things are green. Some stuff is red, especially some of the things that follow BTC a little more closely, maybe are a little softer. But obviously mixed. It's not a clear across the board everything is green, but you can see some rotation going on inside of crypto. A little bit less of that going on over in equities. That's kind of freakishly concentrated. But it is. It's a tough place to be expressing any kind of bearishness because the sentiment is so one-sided and the majority of people are kind of expecting one particular outcome, though in the back of their minds they remember just a few months ago, maybe a year ago, when everyone was talking about recession and that kind of went away. But it's still it's in the back of people's minds. And the thing that I've been struggling with as an analyst here in the last couple of weeks is I'm talking about how I think we're near a secular kind of turning point, but when that happens, when those things develop, if you look back through history, you know, if you look at 2007 and 8, you look at the tech bubble in 2000, which might be a more apt comparison. You look at other past excesses, like the mid 70s when we had the Nifty 50. In those moments, no one ever believes that it's going to turn around at the top. And anyone who expresses those things gets dismissed outright as being an idiot. So that's fair. You have to expect that. But what makes it kind of tough is, you know, I've got people yelling at me in my replies like, just admit you were wrong. I can't believe you're still telling people this. Just admit you were wrong. But crazy thing is, it's like, how can I do that now? How can I admit anything was wrong at this point when what we've talked about is now setting up, like everything is setting up. Bitcoin is at the retracements, right? Equities are at all-time highs, right? The NASDAQ and the Jones reached the 4.236 extension, right? The Fed has completed a tightening cycle. We have all of the cyclical parts of the economy that lead into downturns saying, hey, we're not in good shape. But we're waiting for the other pieces to kind of follow along, right? The first part of the train has turned the bend, but the back part of the train is still going in the original direction. And there's a lot of dislocation, right? We have incredibly concentrated returns in equities among a very narrow band of names, while the majority kind of hang back and there's very mixed participation. They're not outright crashing. The rest of the equities are not crashing, but breadth is staying relatively flat, which if we look at up here, this represents the number of stocks over these moving averages above. They're color coordinated. Let me set this up for you. The blue is the 20-day, the yellow is the 50-day, the red is the 200-day. And as the S&P has been climbing, the number of stocks above the 200-day has stayed exactly where it was at the beginning of the year. It has stayed flat, but equities are climbing. And there's still, you know, another 20, 30% of the market that isn't climbing back over its 200-day. And during this rally, some stocks, there's actually fewer stocks now that are above their 50-day moving averages. So there's a divergence happening inside of equities while we're having like crazy shit like NVIDIA, you know, popping off to all-time highs yesterday after its earnings report, or it's today, I guess, after its earnings report and an ugly 2 or 3 days beforehand. So like a lot of things are setting up in reinforcement of the greater idea that we've talked about on the channel for the last year and in my analysis on Twitter about how technicals for the market are aligning for an elbow turn on a secular basis, the same way that the economy is lining up for some kind of a downturn, a struggling period. I don't know what it's going to look like. I'm not calling for the Great Depression. I am simply stating that the compendium of data that we look at suggests a particular outcome that is not what the market agrees upon. The market believes in a different outcome. And I've been consistent about this since early last year. Even when I wasn't making videos for a while, I was tweeting these thoughts. And then we started making videos again last May or June. I forget exactly when. And I laid a bunch of those things out, and we've been watching. What I think I've gotten wrong, the learnings for me, and I think I touched on some of this last week. What I got wrong, for sure, it's undeniable. What I got wrong was underestimating the strength of risk markets in 2023 as we waited for the setup from 2022 to really play out. And that's something that I'm definitely going to learn from as I participate in future business cycles. If that kind of situation arises again, where I see something developing economically, but the timeline for it is still a year away, which is what scenario we had. So in late 22, early 23, this window right in here, this is when I first built a big database of all the bear markets. I started tweeting about that stuff, talking about how the market always finds a new low in a recession. And then I really started modeling, what's a recession look like? Let's get a bunch of indicators about the economy. Let's look at the cyclical things, manufacturing sales, industrial production. Let's look at incomes and demand and spending. Let's look at labor. What does the NBER use? Those are the people who date recessions. Let's see what they think are important. And so that's that's taken us on this journey. And as I was putting all that data together, it was during this period of time when I came to the realization that if we're going to have this outcome, it's aligning around the same time that equities are near highs. And we've talked about the secular full fib extensions for quite a long time, actually. But before we ever had the economic data, we were talking about the fact that the NASDAQ was near a 4.236 extension off of the tech bubble. And what I definitely missed was we had this bear market in 2022. Everything did, right? This was crypto winter. This was the great repricing of all things at breakneck pace as the bond market sold off. And 2022 was crazy, right? We had 9% inflation in the middle of it in the US. And seeing that there's a possibility of a recession developing near the end of 2023 and into the first half of 2024 being the most likely window of time, that created a big void, right? Because I came to those realizations back here, and the window of time where it was most likely to manifest was over here. So I had these two windows of time, right? And then there was this whole middle area. And I completely underestimated this period of time right here. And this period of time is when Bitcoin actually did most of its damage, right? Or at least the first part of its damage was that period of the year right there. Actually, I should put this on. I'll put it on the same chart above. Let's do it this way. BTC USD, new price scale. Line, please. Line graph. Yeah. So that was when Bitcoin really picked up off the lows, right? Obviously, we know what happened with equities. And after the banking crisis in March and the scare there, we really had the AI bubble blossom into the summer. We know about that. But Bitcoin took off the lows in the first part of the year. And this was during a period of time where I was saying, hey, I just did all this research and I think we're going to have a recession over here. But what I missed was saying, but in the meantime, maybe stuff can go higher and we should just stay long and not worry about it for 9 months. But what I chose to do was continue to dig into my research, find new things to either corroborate or conflict with my view. And then I was sharing that stuff. And so I sounded really bearish during all of this, even though I didn't sell out of the market, even though our whole thesis allowed for this kind of a thing to be taking place. It didn't invalidate, I should say. And none of the rally in risk assets last year invalidated any of our stated thoughts about what we think is going to develop. If anything, they supported those things. But it's been a very difficult cycle to continually have all of this in mind and in perspective, and to be able to effectively call all the turns and to have the right bias all the time. Right. And so that's definitely some of my learning. And that, I think, is where the genesis comes from when I tweet stuff like I tweeted this morning about how I think that we're near the highs for equities. And I've got people in the replies, saying stuff like, yeah, well, you've been wrong for 2 years, so why should we listen to you? And fair enough. I just admitted the ways that I think I was most wrong. And that was by not saying, hey, I think some stuff's going to happen a year from now. 9 months from now is when it's most likely to become the kind of that's the sweet spot based on history. And I've been really consistent about that. You guys know that. But the middle part, I think, was really difficult. And there were people who didn't see the data that I saw, the economic data that I saw, and they're just traders, right? They're just market participants who aren't looking at the economic stuff. And they saw the bullishness for what it was. And kudos to people who were outwardly, loudly bullish in 23 and into 24. But here we are in a place where two different theses have now kind of aligned, right? The technical big picture, I think the market is overextended on a secular basis kind of thing. We've got the technicals showing a really narrow rally and very, very scant participation up here at the highs, both in the NASDAQ and on the S&P. And then we've got Bitcoin at the retracements. We've got Bitcoin at the retracement levels, which for Bitcoin, having nothing to do with equities, thought, during this period of time, BTC, if any of that other stuff was true, then it's most likely Bitcoin's going to set up for some kind of a retracement move, that it's not setting up for a new cycle. And here we are at those levels. So there's no way I can just abandon everything now. There's no way I can go, oh, well, I was wrong about everything because the equities are at all-time highs and we haven't had a recession. This is the period of time we should pay the most attention. So I remain true to my analysis. I will admit it is wrong if people need to hear that later this year, if none of this stuff plays out and everything moves up and all of the risks appear to dissipate. But at the time, right now, those risks are not dissipating. I don't know how to make that more clear. None of that has changed. So, for example, I'll show you just a little bit of the economic stuff. What was I looking at before we started the stream? Yeah, here we go. So we've got all past cycles in this gray line relative to when the Fed starts raising interest rates, which, whether we have a recession or not, happens in all of these cycles. There's a Fed trying to slow down an economy that might have gotten a little ahead of itself. And we find out if the recession manifests or not. But in all of these cycles, there's been a Fed trying to slow things down a little bit. Even in 2020, before that, in 2019, before the repo market blew up, we had a Fed that had been trying to tighten. And so that exists in each cycle. And so, the economy is really strong, right? Atlanta Fed GDP now says we're going to have 3% real GDP. And what would you expect when we're running 7 or 8% deficits? You should expect there to be strong income growth and the economy to continue being able to chug along until something really interrupts that process and forces market participants to take actions they wouldn't have normally taken. That still can happen with large deficits. But in the meantime, those deficits are really stoking the economy. They're really helping incomes a lot. And we can see that here. Here's real personal income. We've got 5.5% Fed funds rate. You can put your money in a money market account and get that on an annualized rate for a deposit. And that hasn't been true for 20 years for a lot of people. There's a bunch of market participants that have never seen that before. Some people are still cash rich from all the stimulus from COVID and the increase in incomes, and they haven't lost their jobs. Like, there's a pocket of America that wasn't hit by the last few years the way that the lower incomes were and the more blue collar people were. And those folks are still largely cash rich. Their incomes are doing okay. Their bank accounts are doing okay. They're spending more for groceries, but they're also making more, and they have enough money that they can put something in a money market, or they can transfer to some other bank that will have them, and they can chase higher deposit rates. And so that's really helping real incomes along with tight labor markets and high wage growth. So on a rate of change basis, real personal income in this cycle, the black line, is looking good and actually kind of structurally raising up a bit. Whereas in the past, in prior cycles, we were coming from a high place and slowing down on real personal income. So because of COVID and just the kind of the weirdness of the last few years, we're actually seeing there was a lowness, a dip in 22, and now a slight acceleration on the rate of change of personal income. This is a growth rate. But if we look at some other things, if we look at certain parts of the labor market, that's still slowing down. That's still slowing down commensurate with past recessions. So if we look at employment composite, which blends the non-farm payroll figure and the employment level figure, which are from the two different employment surveys, if we blend them together, you can see the rate of change of that is actually below the slowdown average of prior cycles. And it's still structurally breaking down. That's because one of the surveys is going down while the other one is holding steady. The employment level, the household survey, which is the one that they ask the actual workers rather than the businesses, that one is reporting weaker and weaker employment growth, employment strength, but it hasn't rolled over yet. It's just softening. Whereas non-farm payrolls, which is the one that most of the headline news organizations report on when they report on job figures, that number has remained kind of robust. And if you recall from last stream, just last week, we talked about how the seasonal adjustments to payrolls, to non-farm payrolls, created a really big number that's actually just kind of a fake number. It's it shows a direction. It shows a positive direction for job growth, but it showed like some 380 something thousand jobs. I forget the number, which we know was not true. There was actually a contraction in jobs, but seasonal adjustments are like a pseudo moving average. So they reported a high number. And that's why it's important to look at more than just non-farm payrolls when you're assessing the job market. And so if we look at non-farm payrolls, that's it right here. You can see this is the tick up from the seasonal adjustments, reporting a really high figure in January, which is likely to be revised down a little bit over the next couple of months. That's been the pattern for the last year and a half, is that we get a high figure, and then over the next 2 or 3 months, as the revisions come in, which is typical, they have actually been revising down on the majority of non-farm payroll prints. I think 10 of the last 12 or something along those lines. So I would expect whatever we just saw in January to get revised down somewhat, and this number won't stay at 1.9%, which is what it jumped back up to. But that's only one of the job figures, right? There is another one, like I said, and it looks like this. It's more volatile, but it's actually slightly negative on a 6-month annualized rate, which means over the last 6 months, it's printed a slightly lower value than what it had 6 months ago. And we can probably see that together if we just go look at it real fast. Yeah, let's pull up CE16OV. Yes, I remember all of the series abbreviations. So we were coming to look and see if it had printed a lower value. Yes, so it's right here, January 2024. That's below the last, 6-7 months of data right here. It goes back to July. So that's why we're now seeing it negative here on a 6-month annualized rate. And when you blend these two together, that one and that one, you get a more cohesive picture of labor, which is a continual slowdown in growth of jobs, job creation. And we still have examples ahead of us of when the recessions began relative to this time anchor of Fed tightening. So when I see that, I can't get excited about 2024 because it's still setting up the same thing we've been following together. Now, there are places that are showing a little bit of strength. What I call cyclical composite is a blend of industrial production, real manufacturing sales, and real retail sales. So before I talk more about cyclical, let's just go look at those three things. So here's industrial production. It's been chopping around at basically even. This is the 0. So on a 6-month annualized rate, if it's at 0, it's just not changing. It's not falling, it's not growing, and it's been chopping up and down around the 0 bound for the last 12 months. So industrial production isn't going anywhere. And if we go look over here, the series will reflect that. I mean, it hasn't gone anywhere in a decade, but you can see it's not really growing. It's just kind of flat, and the peak was September of 2022, 1 month before the low in equities. That's industrial production. If we look at real manufacturing sales, that has picked up a little bit on a growth rate basis, but it's still below its peak. And it's too early to tell if that's a reacceleration. Real retail sales is also really choppy. It chops around a lot, but it's been slowing down on a growth rate basis for the last 5 months, and it's in a contractionary place relative to a 6-month annualized rate. So it's similarly not growing. If we go look at it over here, RSFS. If we go look at it over here, I bet look at it. Look at real retail sales. Now, when you get these retail figures and they're like, oh, retail sales is up 3% year over year, you get these Black Friday numbers. Oh, people are spending money. The economy's doing great. On an inflation-adjusted basis, retail sales have not grown in 3 years. 3 years. So no, I'm not excited about the beginning of a new cycle. I think we're still developing the end of this one. And when you align that with the technicals, it's an ugly picture. A lot hinges on the Fed. A lot hinges on their ability to manage sentiment around this. The interest rate itself isn't going to really change the economy. We've seen that, right? They've raised for 2 years. And they haven't slowed the economy down. If anything, they have been stimulating incomes. because now everyone can get 5.5% deposit rates. And there's a lot of cash out there floating around. You can tell because there's been $1 trillion in the reverse repo, right? There's cash out there. And so really it's about sentiment. It's about the Fed's pace and what the expectations they're able to levy upon the market. And I think that the data shows, because the economy is resilient, even though it's slowing down on a rate of change basis, it's still resilient. Unemployment claims are very low. They just came in today. They're extremely low. They haven't really done anything because labor itself hasn't broken down completely, right? There's a structural shortage of workers. And so we have some hoarding going on, which is we've talked about on here for a long time, actually. Since 2022, we've been talking about the tightness of the labor market and how there is an inadequate amount of labor supply for a full service economy, for a full demand economy right now. And that is allowing things to stay hot. And it's going to make it easier for the Fed to not cut rates anytime soon. They're not in a hurry to. Really, if you take the last couple of years into consideration, 2022, 2023, and now early 24, this is a Fed that's very cautious. They, regardless of what happened before, they've been very cautious ever since beginning the tightening cycle. And they've expressed a lot of hesitation, a lot of apprehension in some ways about wanting to cut early. And the market hasn't wanted to believe them. We've spent a lot of airtime on that. But they're starting to. They're starting to believe that maybe the Fed's not going to cut anytime soon. We're starting to see yields rising just a little bit. Over the last few weeks, the 10-year has been climbing. And I just got the alert this morning that it's over this line here. This was the high from October 2022. We broke over it once, but it looks like we're trying to climb back over it, back above it. So is the 10-year going to climb back up to 4.5? That's just right here. That's not that far away. So we're seeing yields rise a little bit. We're seeing cut expectations finally dropping. The last few weeks we've talked about on here quite a bit about how the market just didn't believe the Fed, right? They were still pricing in 6-7 interest rate cuts this year. That's starting to recede. And for the first time, they've given up on a March rate cut. For the first time. As recently as just last week, it was still like a 35-40% chance, if I recall correctly, which was amazing considering that the FOMC had happened before that, where Powell explicitly was like, no, unless something horrible happens, no, we're not cutting in March. And so finally the market says, okay, fine. It's only a 4.5% chance, but we still don't believe you completely. We're still going to have a margin of error of 4.5%. When you look around at some of the U.S.'s trade partners, they got bunch of PMIs came out today, a bunch of flash PMIs. Germany doesn't look great. Just the summaries at the top of these things. Germany is still at, multi-month lows on composites and on manufacturing output, but services remains high. And part of this, we're seeing a lack of unemployment, considering how bad the services sectors, considering how bad the manufacturing sectors look in like every economy. Considering how bad that stuff looks, which is largely due to interest rates, services remains pretty hot in a lot of places. And because labor in the developed world is structurally inadequate, particularly for all the stimulus that we've been doing. And so I think that it's creating illusions. This is an inflationary cycle. It produces a lot of illusions, and this is one of them, in my opinion. And it allows things to continue kind of bubbling and frothing around for longer than anyone really expects. But Germany is slowing down. But some of the data elsewhere didn't look quite so bad. This is France. France has a 9-month high on the composite PMI, but it's still quite low. It's still at 47. It's still below 50. All of these are quite low. All these figures are quite low. They're coming from a very low place, but they are multi-month highs on all of the PMIs for France. When you look at the Eurozone, same thing. Composite PMI, 8-month high. Still at a low. It's still below 50, but it's an 8-month high. 7-month high on services, right at 50. Eurozone manufacturing, still low. Not looking great. But the services stuff staying hot, like we were just talking about, and the composite at an 8-month high, though it is at a low place. UK PMI, same kind of story, right? Composite output at 53, which is a 9-month high. It rose again. It's coming from a low level, but 53 is not bad. That's above 50, right? That's mildly expansive. It's helped by services. Services is unchanged, but it stays strong at 54. And output rose from 45 to 47, but it is still low. But it's a 3-month high. So it's like we've got the ECB, the Bank of England, and the Fed. Everyone's waiting for when they're all going to cut. Certain countries look like they're going into recessions in certain parts of the economy, like in the UK, in France, in Germany, in Japan, in China. Those places look like maybe they're having recessions, depending on which data you look at. But then you see other data and it's showing maybe a mild pickup in activity. We just ran through Eurozone, UK, and France PMIs, and all those showed mild pickups in activity. Same thing with the US PMIs came out, right? Composite output at 51. It fell a little bit, but it's still above 50. Services fell a little bit, but it's still at 51.3. which is a 2 or 3 month low, but it's still above 50. Manufacturing output jumped to 10-month high. And remember, this is not the ISM PMI. This is a different group running the PMIs, but their output index is at 52. The ISM PMI is, I think, still below 50 for manufacturing, but they follow each other loosely. And so we're seeing a mild pickup. We had inflation, surprise to the upside. Labor is still tight. We have the Eurozone, France, the UK, the US, all their PMIs looking a little better, though some of them are coming from low places. And we've got a Fed who is very clearly saying we don't want to start cutting anytime soon. And that is the policy trap. That's the trap that I've tried to articulate here over several streams that I think puts them in a very tough place. Now, they could just start cutting if things look bad, but what I think the risks that they run into are the economy has set up for a recession historically based on rates of change across the economy. Then we have inflation in this cycle, which regardless of whether you believe the Fed and their rate tools can effectively attack inflation, regardless of what you think about that, their job is to deal with those things. And those are the tools they have. So they're going to try to use them. And based on history, inflation causes them to react more slowly in a cycle where it existed. In every cycle before where there was inflation, the Fed stayed tighter for longer than the market maybe wanted them to. There were calls for them to cut. Paul Volcker got mailed a bunch of car keys in a casket from a car dealership that couldn't sell their cars because they wanted him to cut rates. He was mailed pieces of lumber with nails stuck in them from construction sites that had halted construction because of interest rates. And there was a lot of pressure on them to cut, and he stayed tight regardless. That's just one example. But that's why I've believed that the Fed would stay tight this year. And when you look at their language, that's exactly what they're saying. They're reinforcing those beliefs. And, just as recently as yesterday, there was a little bit of information about that because we got the FOMC minutes. And is this going to load? Okay. Something's going on with Twitter. But the FOMC minutes came out, and they basically showed that the Fed has no desire to cut QT anytime soon, that they're going to try to continue the pace of it, maybe taper it, but allow balance sheet runoff to continue. And they have no intention of speeding up the rate cuts or jumping to a pivot in policy anytime soon. And so we're in this place now where we got to really hope that the slowdown that we are observing, that we are empirically observing a slowdown in labor growth. We have to hope that this doesn't go below zero on a growth rate basis. That incomes remain strong, which is possible if interest rates stay high and unemployment stays low. But then we need to grind through the credit cycle at current interest rates. And that's the real problem. And that's what we've talked about before. We've shown the chart. If I could get Twitter to load, I don't know why it wasn't loading for me. There it goes. Beautiful. And so it puts them in a real bind where we got a strong economy. Labor still looks okay, but we've already articulated the risks there. But we have all of these credit markets that need to roll, and they need to access new debt at the new cost of capital. And wherever the interest rate is, it is significantly higher than where it was the last time they did those things. I don't have the article here in front of me, but I was just reading the other day about the delta in refinancing costs for commercial real estate and for high yield borrowers. Not commercial real estate, for high yield borrowers, and how there's like a 200 basis point, 2%, 3% delta between the financing costs from before and the financing costs today for a bunch of businesses that haven't yet tapped those markets. They've been waiting for the cuts. They thought they were going to get this amount of cuts, but maybe they're only going to get this much. And they really need all of this in order for new credit to cost the same amount or less, to not be a punitive cost. And when you look at the stories in the Bloomberg and in Financial Times, there's story after story of entities doing everything they can to avoid paying current interest rates, taking on debt to pay debt, payment in kind loans, accessing private lenders so they don't have to go to the banks, so they can get, covenant light deals and things that are more friendly to them. That kind of behavior is late cycle as fuck. And I really think that 2024 is a hairy setup for the Fed. And that's all happening while Bitcoin is at the retracements and equities are at full fib extensions off of their prior crises downturns. And they all got there at the same time, which is super weird. It's just, I could go on and on about how fucking crazy this setup is. It doesn't mean that next week is the end of the world. It just means that all of the ingredients are in the pot to cook a certain kind of meal. And all that we're waiting for is someone to turn on the pilot light. And the only way we get out of it is to take everything back out of the pot, right? We got to put together a new meal. We need new ingredients. But we still got to have all the old ones in the stew. Like it's all still there. We're not starting a new cycle. We still have the remnants of the old one hanging on to us. All of the bullishness in the market with, just to take crypto as an example, the fact that everyone is insanely bullish here instead of up here is a red flag just within crypto, right? There's a lot of talk about, well, retail's not here. Well, they're buying $100 million a day of Bitcoin ETFs, and everyone on my timeline is ecstatic. They are euphoric. It doesn't matter what the Uber driver is asking you about. Like there's this barometer for how high we are in the cycle, whether or not the Uber driver is asking you about Dogecoin. Like that's not the measure, right? That's like the very end of a bubble. I think we're in the retracement, and that the peak of the bubble was 2021 and 22. That was the peak of mania. That was when we had pictures of rocks going for $2 million. Like that, we're not going to go back to that again unless we stimulate like that again. And we won't stimulate like that again unless we have a crisis to cause it. That's my opinion. These are all my opinions. And so I think that people are really excited because they see the cycle we just came from, which was in my opinion the strongest impulse leg of the end of the secular bull market. And this is the retracement, what's happening in equities and in Bitcoin. This is the last gasp, regardless of where it goes. And it has less strength, but it also has all the same sentiment. Like the people in the market have the same level of bullishness they had back here. It's just that all the people who left aren't coming back. And we're waiting for them to come back. Well, maybe we're going to have Reese Witherspoon tweeting about Ethereum the day before the Super Bowl again. And that's how you know we're back. And it's like, bro, that was like right here. And that was when every market around the globe was at highs, including art and collectibles and Pokemon cards and Rolex watches and the bond market and real estate of every kind. And interest rates were still zero. So like that was the peak of the bubble. That was the blow off of mania, in my opinion. And we're now in the retracement of the end of that big turn, the massive turn. I'm using Bitcoin on my chart, but really you could apply it to anything. You could apply it to the NASDAQ also. And I think that what's happening right here, this move on the NASDAQ is this move right here. So if the NASDAQ does one of these, Bitcoin is in a retracement and it's going to follow and it's going to go below this. And for the first, and if that is true, if any of that is true, then for the first time in its 15-year history, its primary impulses will be down. Like this would have been the first wave, then we have a correction, then we have another one. We'll see. We'll see. Nvidia, though, Nvidia doesn't give a shit. Incredible, really incredible move. If you've been holding Nvidia since far lower, kudos to you. I don't own any of it. I'm passively exposed, having equity exposure, but I don't actually own Nvidia outright. But I do have some puts on Nvidia to protect me in case I'm right, and to reinforce my view so that I can stay long the markets. I will wait for a high time frame breakdown in structure on a given chart to de-risk from that asset. If it happens to Ethereum, I'll de-risk from Ethereum. If it happens from Bitcoin, I'll probably de-risk a little bit of my BTC. We'll see. Can't see that hype coming back anytime soon. Yeah, David, I just don't think it's realistic, Doesn't mean it can never happen again. Like, let's not jump to the forever talk whenever we say these things. But I really don't think people quite understand what this mania was here and how broad-based it was, and how many of the markers that people are using to decide if we're going to have another one of those they're not going to happen again. Because we won't have this exact thing again unless we stimulate like that again. And part of the reason for that, part of the reason for the mania, I tweeted this the other day to be a little provocative, but also because I was going to use it to talk here, is if you put the COVID stimulus payments on the Bitcoin chart, they're at the bottom, right here at the breakout of the all-time high, and then right here at the highs. These were the 3 COVID stimmy checks that were sent to Americans. And I know this is a very American-centric way to look at things, but I'm American, and they have a lot of money in America, so it matters. And this is where I put it on the Bitcoin chart, but I mean, everything was high here. Look, let's put it on the GME chart. Here, let me make GME align charts so you can see a little better. Here's where the stimmies were on the GME chart. Look, one of the stimmy checks was literally at the highs, right? If you look at the Russell 2000, same thing on the Russell. Look at that. It's just like a lot of markets, NDQ over SPX. I think that peaked right around there too. No, sorry. That's not the one. But still, like either way, I just think it's interesting. And so like, if we're going to have another mania that's as globally broad based as that, because it wasn't just BTC, it wasn't just crypto, it was literally everything. We're going to need a lot more money pumped into the market on an immediate basis. We had the COVID stimmies, but this is just one piece of it, right? We also had $1 trillion worth of PPP loans that were largely forgiven. We had extra unemployment benefits. We had eviction moratoriums. We had student loan forbearance. And part of the services sector was closed off, so people could only spend money on goods and speculation. And that's how we got the bubbles everywhere. Troy says the term you're looking for is echo bubble. I like that term. That sounds good. I don't know if that has like a meaning in people's minds. I don't really know, but I kind of get what it means. Yeah, it's an echo of the bubble. It's the retracement, right? Like It's not just a retracement on the chart, right? It's a retracement of the mentality that produced the bubble. I've talked about on this channel before how ideas are markets unto themselves. And I think that it's something that I use a lot when I'm framing my perspectives about something. Ideas are a market. They are an unpriced market. You have at all times people buying into an idea, selling out of an idea. An idea can have a bullish ascent with more and more people adopting it into their personal belief system. Then you can have a bearish descent where you have people selling out of an idea or being forced out of an idea that they were previously convicted in. And that can create a downtrend where something becomes less popular. And ideas, just like markets, can get overpriced, right? And they can become undervalued, undersubscribed. They can have people whose cost bases are far too close to current action so that they are paper-handed in their subscription to that idea. And you can have people who have been subscribed to something for a really long time. They've believed in something for so long, they're never given up on it, no matter what, and they'll go down with the ship. That is exactly like every single price chart. The holder base of every price chart is exactly the same way, because a market is just a bunch of humans with opinions expressing those beliefs and taking action. And we condense it all down to a single number that represents the end result of all of that stuff. And all the information that every one of those players contains in their mind is condensed into their action, and it manifests in the price. Everything they know about the Fed, everything everybody knows about interest rates, about the future, about the businesses that they work in, about the health of their local markets, about how they're feeling about the future, their sentiment about the shit going on in the Middle East, about Biden, everything is contained in the market price. And the same, and people buy in and sell out of ideas. And one of the ideas that I think has become oversubscribed, there are several of them actually. One of them is the belief in eternal 4-year symmetrical cycles for Bitcoin and crypto because of the halvings. But we've looked at here quite a bit about how the halvings conveniently align with a lot of other events outside of Bitcoin that kind of make you scratch your head about what the true catalysts are. And we have people oversubscribed to the idea that no matter what happens, the Fed can always rescue the markets by just quote unquote printing money. There's a lot of ideas like that. And animal spirits are also something that can become, overweighted to one side. And I think that when you create a bunch of cash, you just rain it down upon people with no requirements as to how they spend it. And over a period of many years, you reinforce a moral hazard in the market. You reinforce risk appetite and this belief in an impenetrable market. Then yeah, you're going to have some really heavily invested ideas centered around risk appetite and risk taking and how nothing can ever go down. And it's going to be really hard to express a counter view to those beliefs when they have not yet been proven wrong. And that's the phase that I feel like we're in right now, where if depending on what you look at, there are markers that dynamics are different. Certain things are changing that will have a role to play in whatever crisis develops from all of the excess. And I believe that one will develop. Maybe it's obviously a slow moving process, but we've been talking about global recession, and countries one by one are slowly slipping into one. China is literally having a great financial crisis right now. And they are not going to be a boon to global growth for the next few years. If anything, they will be a drag or a net neutral because they can't stimulate the way they used to. But they still got a bunch of people buying the dip on China and expecting that any time that there's a stimulus announcement, that it's going to be, the 2009 all over again, and we're going to go straight up because China's stimulating. But they're not seeing the writing on the wall. And that's just one piece of it. And you've got all of this latent risk-taking appetite in the market. We've got people extremely bullish very early in a crypto cycle, which is quite bizarre. And it's helped by the ETFs. And, it's just, it's fascinating to be a participant in this period of time here. There's so many conflicting opinions. I certainly don't know. These are just my opinions, right? I could be wrong about everything, which is why I always stress to you guys not to take my advice, right? Just listen and be entertained and take it at face value. I have no idea. No one does. But I've got warning signals just flashing in the back of my head that we're at crunch time. And any week I feel like I'm going to wake up and I'm going to see some like crazy news story on my phone that turns everybody's sentiment around suddenly, because it's already so fragile up here. We've already got so few stocks actually participating in the rally. It feels very fragile. And that's all I'm going to say about that. I'm going to take a sip of my water. My throat's super dry. If you've been listening to me for the last 50 minutes, god damn, dude, I really need to get better at making my monologue smaller. If you've been listening to me this whole time, hit the like button. One thing I wanted to talk about is Bitcoin supply. And I will do that here, but let me catch up with the chat. There's 277 viewers and way less than that in the number of likes. Smash the thumbs up button if you're sitting here listening to me right now. Andrew Handelsman donated earlier and says, hello. Thank you, Andrew. Hello. Appreciate that. Code 9, gifting a membership. Appreciate it. Smelvin Wrong, welcome. Code 9 gifted for you. He joined. That's a new member. Code 9 gifted a membership and then Smelvin Wrong joined. Excellent. Welcome. You guys will have access to the next member stream that we do a couple weeks from now. Stimulate me, China. That's funny, Big Shroom. All right, I'm catching up with the chat here, and then we're going to talk a little BTC supply. There was a couple of data points I want to show you guys that help reinforce my opinion that the market is much bigger than anyone gives it credit for. Brandon Hammond is listening to me at the gym today. You know what, Brandon? There are like 3 or 4 of you guys who listen to me at the gym. I know it was last stream. I had BC, I think it was BCB, told me he was at the gym either last week or the week before. And that same week, 2 other people were like, yeah, I was at the gym listening to you. I was like, okay, cool. Get after it, guys. Go to the gym at 11 a.m. Do it. Rince asked me, Rinswind, why did YouTube play a Japanese ad? I don't know. I don't control the ads. Ideas are like those markets. Yes, Matthew Hebert. Ideas are like markets. That framing has helped me so much. Bullish as always. Yes, Fast ETH. Always bullish. Always bullish. Feel like you've been saying it's a top. No, Adam, I haven't just been sitting around saying it's a top. Here we go. If this is a top, and it could be, are you going to say you called it after being bearish all of 2023? So again, I'm not going to spend a lot of time on this. I've been bearish about this moment of time. If you look at my tweets as recently or as far back as the first quarter of 2023, I was talking about 2024. And every time I posted something, I said, we're still likely to have a recession. The lows are probably not in. I said in like June or July, what if the S&P and the Dow, or what if the Dow Jones and the NASDAQ are about to print a new all-time high, just like Bitcoin in 2021? I'm open-minded to that happening. That's where we are. That's me actually being bullish on equities. I literally said in like June or whenever it was, what if the Dow and the NASDAQ are printing a similar fractal to Bitcoin in 2021? If you actually think about what those words are, that was me expecting equities to go to all-time highs. I can only articulate my opinions in so many ways. People can listen to them or not. They can hear the parts they want to hear or not hear them. I can't force you to hear it all, and that's fine. But let's at least just be truthful about what it was. I spent the first part of the stream talking about how I could have improved my read of the market. So if you really want to hear me expressing some of that, go back like an hour and start over. I see all your arguments. On Bitcoin, what you call a retracement is longer in time than the 2022 downturn. How do you justify that? I don't really worry about the time factor too much on the waves on Bitcoin. So I don't have a strong opinion about that, Marcos. Is it possible the high interest rates are contributing to the GDP growth in the US? Ursik the Pro asks. That combined with the IRA makes the US a great place to invest, and investment's part of GDP. Yes, high interest rates are likely contributing to GDP. High interest rates are contributing to incomes, which are contributing to spending, and consumption is 2/3 of GDP. And another piece of it is the large deficits themselves are a piece of GDP. They're actually in the GDP calculation. How is white collar unemployment measured for the people who don't apply for unemployment benefits? Yeah, Aleem, some of those people don't apply for unemployment. That's true. Not everyone does. There isn't like a white collar unemployment, to use your phrasing. There isn't a white collar unemployment like measure. You could look at job losses in certain sectors and create a proxy, like tech jobs, information jobs, things like that. But I don't think that you'd be able to get a real clean number on there. What about the 50 states unemployment going up? Aleem says, yeah, what I was trying to do, Aleem, actually, it's funny you say that thing about the different states. What I wanted to do was chart the unemployment rate for the 50 states, but I couldn't get it together in time for the stream. So maybe we'll put that away. Maybe we'll do that next week or at a future date. But unemployment is kind of all over the place in different states. Like it's really low in one place, it's really high somewhere else, and it's producing a national average of 3.7, 3.8. But it's rising slowly in a bunch of different states. And that's something to be paying attention to. Iguana says manufacturing in Germany is going down because of extremely high electricity costs and companies are struggling to get employees. Yes, they have a lot of problems in Germany. They moved away from nuclear power for a while there, and that was a bad idea. They became overly reliant on Russian gas that was very cheap. And then, Russia invaded Ukraine, and, NATO doesn't like that. Then they also are losing out on manufacturing to China. China's a major car exporter now, and that's really hurting Germany. And then we have high interest rates around the world, which are affecting manufacturing around the world. And Germany is a manufacturing hub. So they're getting hit from all sides. They also are the backbone currency of the Eurozone, which has a lot of other weaker members attached to it. So that's not good for them either. Bart says, I find it hard to believe that we can go past the mania high with these market conditions as they are currently. I believe so also, Bart. I would be really surprised if they did. Obviously I can be wrong. Of course I can be wrong. And I would like to be wrong because then everyone's making money and everyone's really happy and I'm just an idiot. But it's hard to fathom that. And I think that the excesses of 2021 set an unrealistic limbo bar for people for what they think a bullish market's supposed to look like. Like it's a really unattainable bar that you are looking for 2021 again, because I don't think it's going to look like that. We can be bullish without looking like that. That was a mania. Kind of what's going on with Nvidia right now is what everything was doing in 2021. Everything. Just ripping nonsensically. Like, holy shit, this doesn't make any sense. Why are you still going up? It's because there's money and people are just piling into this one thing. They don't think that it'll ever end. Catching up with the chat. Andy Philpott gifted a membership. Thank you, Andy. Eric Martinson also gifting a membership. Welcome, boys. Welcome. Aaron asks, can you share your thoughts on whether the impending recession is a larger ploy to crash the markets, to move the masses towards crypto, to eventually crash that and usher in a financial reset via CBDCs? No. I'll just say no. That's not what I think is happening. I don't think anything is coordinated to that degree. I think certain things are coordinated, and there are incentive structures that do not benefit the masses that we don't see. Some of them we do see. But no, I don't think it's coordinated to that level. Some of you guys are pretty funny. How do we join as members? Well, if you go to the channel, I don't know if you can do it on mobile, but if you go to my channel, up at the top, there's a button right next to subscribe that says join. And if you do that, it's $5 a month. You certainly don't have to. We do these public streams once a week. And I don't ask anyone to subscribe. People have chosen to do that out of generosity, and I'm very appreciative. And so if you choose to do that, your name turns green, and you get a little soup can next to your name, and then we do a member stream once a month, a private stream, where we just hang out and shoot the shit. And maybe we'll do more in the future, but we've only been doing this for a couple of months, and that's what we've been up to. All right, I'm almost caught up with the chat. Anna Wong's thread about how unemployment insurance eligibility is an all-time low because of gig work. Yeah, I saw that, General Jackass. I just didn't have enough of my thoughts around it to really look at it here on stream. Yeah. Excellent. All right, so there's something I want to talk about with Bitcoin supply. And so what I've talked about in here with you guys quite a bit over the last couple of years, or the last year, I'll say that. Really emphasizing it a lot whenever we talk about Bitcoin supply, is that the market for Bitcoin is bigger than people give it credit for. A few months ago, we looked at Fireblocks, which is kind of a behind the curtain custodial institution that has their own network, and they can facilitate meaningful economic activity between thousands of different participants in crypto and TradFi. They have a huge network, and they have access to tens of billions of dollars of assets. On their website, they list like 40 or 50 billion dollars under management. Under management in quotes, because they're a custodian. They're not like an investment group. But what I've also talked about a lot is how the exchange balance figure that you see on Bitcoin that represents for people this idea of an impending supply shock, that number doesn't actually represent Bitcoin's market in full. That there are many other places where BTC exists close to the market, and we're not seeing it in those numbers. And so I want to spend a little bit of time on this today, because I finally got to see the chart, which you're seeing here, that exactly reinforces my argument. So I've said quite a bit, and I had this tweet from a while ago where I was saying Bitcoin is not being ripped off exchanges. There's a misunderstanding of the data. Coinbase has a publicly listed exchange balance, which has been going down really mechanically, right? These like stepwise functions. It's really straight, lots of right angles. You see that? And we've always thought that was really weird, because this is what an exchange balance looks like. It's very choppy. It looks like a price chart. These coins are still with Coinbase and are held in Coinbase custody. It is a continual transfer into hidden custody that creates an illusion, which is untrue. If you take Coinbase out, you will see that all other exchanges are still flat for the last 3 years. And a bunch of people were like, hidden custody? What are you talking about, dude? That sounds stupid. And so then I went, okay, well, Brian Armstrong came out and said, when CoinDesk went, hey, a bunch of Bitcoin left Coinbase, Brian Armstrong said, this is false. This isn't our data. And so I went, correct. That's because publicly listed exchange balance is not showing you everything that is with Coinbase. So I retweeted that and I said, hey, check it out. People still didn't quite believe me. Some people believe me. But then just a few days ago, Checkmate shared this chart. Here's a higher res version of it. This 100% corroborates what I have been saying, so that you will know I am not making it up. This dark blue line is the balance of BTC on Coinbase. You see these mechanical stepwise down moves? That's the line, right? That's the Coinbase line from the tweet from over here, the nested tweet. Here. See the stepwise line that's in blue? Same blue right here. This middle blue is Coinbase custody. And you will note that it is very large. You will also note that as of right now, as of late 2022, in fact, it is at the level that was the high for Coinbase's exchange balance on the publicly listed side of the exchange balance. Over here, the high for Coinbase was right here, where the blue line is, right here. That's this spot right here. And Bitcoin is still with Coinbase. It's just in Coinbase custody. And so as Bitcoin leaves the publicly listed, in quotes, balance, it just moves into custody. And they've lost a tiny bit here, you can see. It's not insignificant. It's a couple 100,000 coins. But they still have most of it. And I was just so excited to see this chart because it's finally the data behind what I've been saying. You know, I can only say, I know the guys at Glassnode so many times. Eventually, I've got to show the goods. Well, here's the goods. And so then I measured the size of this block on the left axis. And it's about 500,000 Bitcoin, loosely, right? That's roughly how much is inside Coinbase. Well, if we look at Coinbase from 2019 all the way back, go back like 3 years, go back on this chart to back here when they first reached up to their highs on exchange balances. Back here, the 2019. Since then, Coinbase has lost about 512,000 Bitcoin from its highs. This block is almost 500,000 Bitcoin. They're still with Coinbase. The only difference between this block here and this block here is that this one is in Coinbase Prime, Coinbase custody. So there is a different accounting tag on it, and there is a little bit more friction involved in moving those coins. They are not inaccessible. They are not unavailable. There is just an extra layer of friction in accessing them. And that is so important to understand because these narratives about the exchanges are so popular. They're so popular. And it was just a few days ago that I just replied to some dude like yesterday or the day before because it was just, here it is, right? I tweeted this. Whenever you see this picture of Jim's face, this is my face. When it's Bitcoin is being drained at an alarming rate. The number of those who will never allow their Bitcoin to ever return to a centralized exchange is increasing at an alarming rate. It's the scarcest asset on earth as of April. And I'm not trying to pick on this guy. Like their name isn't even important. I'll just hide their name. Like it's irrelevant. But the point is that the market is much bigger than people give it credit for. The Bitcoin is much closer to the market than people give it credit for. It's not a monolith. Bitcoin is an organism. It is an active, moving asset. It is always churning. And the supply is turning over at different points in time all the time. Big chunks of supply, not just the coins that are mined each day, but hundreds of thousands of coins are moving around all the time. Because Bitcoin is available. Just because it has a hard cap of 21 million doesn't mean that you can't get your hands on it if you want to. Doesn't mean that there are not people who have made a market for the supply that they hold. And that is so important for you to know if you want to be on this journey, because people will convince you, or try at all times to convince you, that there is a fight happening over the last Bitcoin. And it just isn't true. If we look at the exchanges minus Coinbase, because we know we've got this thing happening with Coinbase custody, and we've already established that they have essentially the same balance that they had 4 years ago. If we exclude them and we look at every other exchange since the beginning of 2019, they actually have more Bitcoin than they had back then. And in fact, they've been largely flat since 2019. 33,000 extra Bitcoin. And that is everything else. That is every other exchange. Let me show you. It's all of them over here. It's not every exchange in the world. It's every exchange that Glassnode has listed. Binance, Bitfinex, Bithumb, BitMEX, Bittrex, Bybit, CoinEx, Deribit. FTX is in the data set, but we know they have zero. But it's all of them, right? All of them except Coinbase are not losing coins at the fastest pace ever. It's not becoming the scarcest asset ever. People are not fighting over the last Bitcoin that gets mined every day. It's a big market. It's a really big market. Additionally, there are other sources of supply that we don't see, right? I've made that case before. And now that I have seen this data and you see that I'm telling the truth and this is all valid, all these coins are still held with Coinbase. There are other places too that have a lot of BTC, like a lot. So right now, Coinbase has their publicly listed balance is just under 400,000. It's like 390. I'm going to round. It's about 390,000. Well, this is Robinhood's 10Q filing from Q3 of 2023, just last year. They don't have the Q4 filing yet. As of September, 5 months ago, they had $3.8 billion of Bitcoin. And that's when Bitcoin was at 26,000. Read this closely. The fair value was determined based on the last price as of September 30th, 2023. The last price on September 30th of 2023, the closing price was 26,966. 26,966. 3,858. That's the amount they had. 26,966. 133,000 Bitcoin are on Robinhood as of 5 months ago, and it was up huge from 9 months before. So now, granted, some of that is valuation change from December to September. But some of it is also Bitcoin going on Robinhood. But they have 133,000 Bitcoin. They have half as much as Coinbase. And they are not listed over here. Neither are any of the ETFs. Neither are the custodial holdings of Fidelity, separate from the ETF. There are many other exchanges that are not on here. Just crypto exchanges that I can think of, let alone places in the US that also you can get BTC on. Cash App. So we have no idea the true size of the Bitcoin market as a number. But what I can tell you is that it is bigger than everyone gives it credit for. And people telling you that we are continually squeezing and shocking this supply down to a point where we're all going to fight over the last Bitcoin at $5 million is just spinning a yarn for you. They're telling you a story, and they're using high school economics to explain a very complicated asset. All right. Gerald, welcome. Became a supporter of the channel. Thank you, brother. Welcome. You'll have access to the member stream. We'll do one in 2 weeks. David, gifting 5 memberships. Excellent. And David's been a member for 2 months. Welcome, brother. David is the original first membership gifter on the channel. He was the first one, the first day that I had them live. We've got a lot of other folks, generous friends in here who've gifted memberships. But I just always remember David's name because he was the first one who did it. So thanks again, brother. So I wanted to share this about BTC, not because it's not FUD. It's just information. It's education. If you want to pay attention to BTC, if you find on-chain interesting, if you follow people who talk about that kind of stuff, then it's important for you to have a seasoned perspective, to have a full perspective, and to know what you don't know. That's the takeaway from this, is that I know what I don't know. But most people who talk about the data in Bitcoin, they don't. They talk as if they have the full picture. And I have just articulated for you why they don't. What else? I had a couple of other things. I'm just going to see, did I have any other tweets loaded up? Yeah, here's another one that reinforces that the market can suddenly be very, very big relative to what you think. So I tweeted this morning. I retweeted Kai. Kai is, I'm probably fucking up his name, so I apologize. But he runs CryptoQuant. And he tweeted this out. He runs it's another one of Glassnode's competitors, and they have their own data. They track OTC desks, and they track a different group of OTC desks from what Glassnode has. Glassnode tracks only 3 OTC desks, and their OTC desks don't show any activity. If you go look at OTC desk holdings, they're all the way down here, right? They only show 500 Bitcoin. It's almost like the desks they're tracking have just stopped working or something like that, because he tweets out OTC desks for miners here, another set of OTC desks, and it just showed a massive jump in the amount of Bitcoin held by it, 700K BTC. And if we go look at the chart, I think I can look at it over here. Let's see. Oh, I'm not signed in. Bummer. Okay, I don't have a CryptoQuant account. But it's about 700,000 Bitcoin. Now, I don't know which OTC desk this is. There are a couple dozen of them, I think, actually. So it's kind of weird that Glassnode only tracks 3 of them. But they say that they only track 3 of them. 3 different OTC desks. But there are a lot of them. CryptoQuant has a better list, and whichever ones they track show a huge jump. Now, that's one move. So that suggests that maybe it's one desk and one player who just moved a shitload of supply over there. And it doesn't mean it's going to get sold right away either. My takeaway is this shows you 700,000 Bitcoin is a lot, y'all. That's a fuckload of Bitcoin. 700,000. Oh, crap. It's 3.5% of the supply. That's nuts. Just jumped onto this exchange over here. Is that 3.5? Is that right? Is that really right? 19.600. Yeah, 19.6 million. Oh crap! Wrong way. 700,000 divided by 19.6 million. Wow, it sure is. Holy crap! Times 100. Yeah, 3.5% of the supply. The thing I just wanted to show was that Bitcoin is a lot bigger than people think. The supply is more active than people think, and it is turning hands more often than people believe. And so when they see something that shows the amount of supply last active in 1 year and how it just keeps climbing, they take this to mean that all of this supply is a hunk of rock, and that it's inaccessible, and that it's only something that's just going to get added to, except for extreme moments. But what they're not really getting is that this is a flow, right? This is the end result of a flow. At all times, every day, there is a bunch of supply that moves, and there's a bunch of supply that is reaching its 365th day of not moving. And at the end of the day, we have a number. But it doesn't mean that everything that didn't move yesterday also didn't move today, or what, you know, I'm trying to, like, it is a living organism. Every day something is being spent out of every one of these cohorts. Supply last active 2 years ago, 5 years ago, 1 year ago, 6 months ago, 10 years ago. Some amount moves out of all of these buckets almost daily. And every day, a few more coins join the group, and we get a net result. And that net result is this line. So the supply is always moving. And when the market really takes off, A whole lot of it can move more than normal, and you can get big breakdowns in this measure of inactive supply. So the ETFs coming online, the fact that they have a lot of demand, that is excellent. But their amount of demand is only a slice of the pie. And if they're hoovering up, 40, 50,000 Bitcoin a week or something, I don't know what the average is. Well, there's more than that is transferred to exchanges from long-term holders on a weekly basis. So, closing some of my tabs here. So that's a picture of Bitcoin supply. The OTC desks are not empty. Demand activates supply. Nothing happens in a vacuum. The exchange story is widely misreported. We have been confirmed that that is true from the people who put the data together. And so we can, with confidence, put aside the supply shock narrative. And I think it's important for people listening to me right now to understand when I say that we are likely to not have a supply squeeze, I think it's important for you to know that the first video I ever made on this channel was called Evidence of a Supply Squeeze. September of 2021. So when I'm saying that, that is me changing my prior view, my prior foundation, based on a new understanding of the data. So I can change my mind, and I used to parrot this narrative. And I am here saying that I had that wrong. I was too early in my understanding of some of the data back then, and I've learned a lot since then. And this was just not true. Even if price went higher from this point, it doesn't mean that my evidence for why it happened was true. Let's go check on the markets real quick, and we're going to start wrapping up here. NASDAQ up 2.78%. I think it's pretty interesting today. It's up 2.78%, and the jump that it made today took it right back over the 4.236. Like it broke down off of it, and then the squeeze today on the open put it right back above that level. So this is an interesting place. We got Bitcoin still just hanging out at its retracements. It's been there for a while. I don't know if the pico top of Bitcoin is in, but I don't think it's very much higher. And I tweeted a meme a couple of months ago saying 10K before 60K. And if you really actually are interested in my views and you follow them in full, that is me reducing down to a meme my entire belief system about the market currently, my entire thesis about the market, which is that this is a retracement. It's likely near the highs. Markets will probably go lower rather than continue to go higher. And because of the economic setup, a recession is really likely. And if that plays out, it reinforces the technicals and it makes a new low very probable, because that's what happens in every recession to equity markets. Bitcoin follows tech, and it's now even more tied because we have the ETFs. So when I say 10K before 60K, that is a really snarky, tongue-in-cheek way of saying, I think we're near the highs. I think a recession is likely. I think equities are near their peaks. Sometime soon here, we're probably going to start rolling over on a secular basis. And I think before it's all said and done, we'll make new lows before we make new highs on Bitcoin. And for the culture, I have an alert set for 60K and for 10K. Just for the culture, and put it to back up my statement. We'll see. If you are not subscribed, make sure you're subscribed. If you have not hit the like button, make sure you hit the like button. We do these streams every week. I get on here and I rant for a while. The chat is quieting down. There aren't as many questions, so we're going to start wrapping up here. Sometimes there's a lot of questions and it takes a while to get through them. We will get back together next week. Hopefully we'll have a few more things about the market to talk about. We're kind of in a holding pattern here. You know, with what happened with NVIDIA yesterday, I'm not going to get too excited about any of the moves today and risk. I see alts catching a rotation with BTC at the 702. That is usually a late cycle dynamic. So we'll see. But I think when all is said and done, I'll be more right than I am wrong about this stuff. We'll find out. I did want to talk a little more. There were a couple of news stories I was going to read through, but I spent more time on the first stuff than I thought I would. So we'll just save that for later. The next member stream. So the last one was February 1st. So we'll do another one in another week or 2 weeks maybe. Yeah. Joe says, I'll bet you one BTC that we hit 60K before 10K. Well, that's not a good bet for me, Joe. So no, but we can have a friendly wager through the chat here. All right. That is where I'm going to wrap up. We'll do another one of these next week. Like I said, membership stream will be in, let's look at the calendar. So we did one here. We'll do another one maybe next week or the week after. I'll decide before next Tuesday or Wednesday, and I'll schedule I'll put something out about it. I'll say something about it. Mike, if we closed the monthly candle above the 4.236, yeah, that would be interesting. We're not going to get this far into a thesis for it to all be invalidated from like a single candle close or anything like that. Not that you put those words in my mouth or anything, but just for clarity, that's not how I am going to ride this train, right? I'm not looking for just a single candle close because I didn't trade this move. So I don't need that kind of a clear invalidation. I just think that this is a level that's going to be the end of the cycle. Now, obviously we're above it. I don't know where it goes above it. Maybe it goes way above it and comes back down and then we continue the track. I don't know what's going to happen, guys. But I just have opinions and they're well considered. And I'm not going to get all the way down to here and then go, oh, it's not happening, just because maybe like the monthly or something closes above a horizontal line I drew. So we'll see. Thank you so much, guys. I really appreciate it. Yeah. So until the next time we meet, take care of yourselves. Take care of each other. I'm going to go outside and take a walk around the neighborhood, stretch my legs a little bit because I've been sitting at the desk all morning. I really appreciate y'all who come here and hang out and hear my thoughts in full because I abridge them for Twitter. Twitter doesn't get the full extent of my views. It's impossible to articulate them there. And it's a lot. It's just not fun for me to deal with the reply guys over there. It's becoming less and less fun as we go higher. So I appreciate people who come here because they actually just want to hear what I have to say. Maybe it's entertaining. Maybe you think I'm wrong, but you just like to hear it. That's cool too. Whatever your motivation is fine with me. Thanks for being here. We'll talk again a week from now. Take care of yourselves, friends.